Did you know that 60% of young adults are falling into a debt trap they never saw coming? Those buy now, pay later buttons popping up at checkout aren't the financial life hack they appear to be. I spent 6 months investigating the BNPL industry and uncovered shocking tactics these companies use to get you spending more than you can afford. One user I interviewed racked up $7,000 in debt across 4 BNPL services without realizing it until collection calls started. The illusion of free money? How BNPL actually works. Ever wonder why these payment buttons are suddenly everywhere? Let's pull back the curtain on what's really happening with buy now, pay later services. They've exploded onto virtually every checkout page, promising a smoother shopping experience with zero interest. But how exactly do they work? And why are retailers so eager to add them? At its core, BNPL operates on a deceptively simple premise. Take home what you want today and split the cost into manageable chunks. Most services follow a standard formula, dividing your purchase into 4 equal payments spread over 6 weeks. You make the first payment at checkout, then 3 more bi-weekly payments automatically charged to your linked payment method. No interest, no hassle, just 4 easy payments. But here's where things get interesting. Despite marketing themselves as the consumer-friendly alternative to credit cards, BNPL operates on a business model that's far more complex than the clean, minimalist buttons suggest. These aren't charitable organizations offering free loans out of the goodness of their hearts. Take a look at the major players dominating the space. Klarna, with its pink branding and sleek app, Affirm boasting its transparent pricing, Afterpay with its widespread retail partnerships, and PayPal's Pay in 4 option, leveraging its established payment infrastructure. These companies have strategically integrated with thousands of online retailers, from fashion giants like H&M and ASOS, to electronics sellers and even grocery delivery services. What most shoppers don't realize is that behind each of these payment options lies a carefully calculated business arrangement. When you choose to split your payment, the merchant isn't just being nice. They're paying a premium for your business. BNPL providers typically charge merchants transaction fees ranging from 3% to 6% of the purchase amount. That's significantly higher than the 1.5% to 3% fees associated with traditional credit card processing. So why would retailers willingly pay double or even triple what they'd pay for normal credit card transactions? The answer reveals the true genius of the BNPL business model. These payment options dramatically increase sales volume. Merchants report average cart sizes increasing by 20 to 30% when BNPL options are available. Shoppers are simply more likely to complete purchases and spend more when they can spread out payments. Think about it from the retailer's perspective. Would you pay an extra 2 to 3% in processing fees if it meant 25% more sales? For most businesses, that math works out favorably every time. The BNPL industry has grown at a staggering pace that reflects this win-win arrangement between providers and merchants. What was a $2 billion industry in 2019 exploded to over $24 billion by 2021 in the US alone. Global figures show even more dramatic growth, especially as the pandemic accelerated online shopping habits. Industry analysts project the market could reach $100 billion in transaction volume by 2025, a 50x increase in just 6 years. This meteoric rise hasn't happened by accident. BNPL providers have masterfully positioned themselves as budget-friendly alternatives to traditional credit, emphasizing their interest-free structure and easy approval process. Their marketing language focuses on empowerment and financial flexibility rather than debt or loans. Notice how they avoid loan terminology entirely? You won't see words like borrowing, interest, or debt in their marketing materials. Instead, they use friendlier terms like split your payment, pay over time, or flexible payments. This careful language choice is deliberate. It distances BNPL from the psychological weight of taking on debt. But make no mistake, these are loans, just packaged differently. They involve borrowing money to make a purchase and promising to pay it back later, the fundamental definition of a loan. The fact that many BNPL services don't charge interest doesn't change this reality. It just means they've found other revenue streams. So if these companies offer free loans without charging interest to consumers, how do they make money beyond merchant fees? This question gets to the heart of understanding the true BNPL business model. First, there's the late fee structure. Miss a payment, and you'll quickly discover that interest-free doesn't mean fee-free. Afterpay charges up to $8 per missed payment, capped at 25% of the order value, while Zip, formerly QuadPay, charges up to $10 per missed payment. These fees may seem small compared to credit card interest, but they add up quickly and become a significant revenue stream for BNPL providers. Second, some BNPL services like Affirm do charge interest on longer payment plans, sometimes reaching 30% APR depending on your credit profile and the purchase amount. These interest-bearing options typically apply to larger purchases with extended payment terms beyond the standard pay-in-4 model. Third, many BNPL companies have developed their own shopping apps and marketplaces where they earn additional commission on purchases directed through their platforms. Klarna's app, for instance, allows users to shop at any online retailer through their interface, earning the company referral fees on top of their standard merchant fees. The brilliance of this model becomes clear when you step back and see the bigger picture. BNPL companies have created a three-sided marketplace where they extract value from consumers through late fees and data collection, merchants through transaction fees, and advertising partners through sponsored placements in their apps. This multi-revenue approach has made BNPL incredibly profitable despite the seemingly consumer-friendly, zero-interest promise. In fact, the lack of interest charges is precisely what makes it so palatable to consumers and so effective at driving sales volume for merchants. So is buy now, pay later a financial tool or a debt trap? The truth lies somewhere in between, but leans heavily toward the latter. These services weren't designed primarily as financial wellness products. They're marketing tools disguised as payment options. Their primary purpose is to increase sales for merchants by reducing the psychological barriers to purchasing. The evidence is in the data. 45% of BNPL users say they use the service to make purchases they otherwise couldn't afford. That's not financial empowerment. It's encouraging spending beyond one's means. When almost half of users explicitly acknowledge they're buying things they can't afford, it's clear these services are enabling consumption rather than promoting financial health. The seamless integration of BNPL options at checkout isn't coincidental either. These buttons are strategically placed at the moment of maximum temptation, when you've already decided you want something but might hesitate at the total price. By breaking that $200 purchase into 4 payments of $50, BNPL providers make the spending decision feel more manageable, even when the total amount remains unchanged. This psychological trick is the core mechanism behind BNPL's effectiveness. The companies aren't helping you afford things. They're helping you feel less pain when buying things you might otherwise reconsider. The immediate gratification of getting the product combined with the delayed pain of payment creates a potent formula for increased spending. The psychology of spending. Why BNPL makes you buy more. That potent formula isn't just a happy accident, it's neural engineering at its finest. BNPL buttons are carefully designed to hack your brain's financial decision-making, triggering spending impulses you didn't even know you had. These innocent-looking payment options are actually sophisticated psychological tools that exploit how your brain processes money and purchases. Have you ever noticed that strange feeling of discomfort when handing over cash for a purchase? That's what behavioral economists call the pain of paying, a genuine psychological discomfort we experience when parting with our money. It's actually your brain's built-in protection mechanism against overspending. But BNPL services have found a brilliant way to short-circuit this natural defense system. By breaking payments into smaller installments, these services dramatically reduce that pain signal. When your brain sees 4 payments of $25 instead of 1 payment of $100, something fascinating happens. You feel less financial strain, even though the total amount is identical. This isn't just convenient. It's a calculated psychological manipulation that makes you feel more in control of your finances than you actually are. The real genius is how BNPL taps into what psychologists call anchoring bias. Your brain fixates on the first number it sees, that smaller payment amount, and uses it as the primary reference point. So when you see $25 today prominently displayed, your brain automatically perceives the purchase as more trivial and affordable than it truly is. The total cost becomes secondary, almost an afterthought, effectively lowering the perceived cost of what you're buying. This psychological trick works so well that studies show consumers spend up to 40% more when using BNPL compared to paying up front. Think about that for a second. That's not because these people suddenly have more money. It's because BNPL has fundamentally altered how their brains evaluate the purchase decision. What makes this even more powerful is the timing. BNPL providers aren't placing their buttons randomly. They're strategically positioned at the exact moment your financial willpower is at its lowest. You've already invested time browsing, selecting items, and reaching checkout. You've mentally committed to the purchase, and right when you might reconsider due to the total cost, BNPL swoops in with its tempting solution. One shopper I interviewed admitted, "I was about to abandon my cart when I saw I could split the payment. Suddenly it felt totally manageable, so I completed the purchase." This is exactly the moment BNPL companies are targeting, that brief window of purchase hesitation where a consumer might otherwise walk away. But the psychological tactics don't stop there. BNPL options are frequently paired with urgency triggers designed to create fear of missing out. Limited time offer, only 3 items left, selling fast. These prompts create artificial time pressure that further compromises your decision-making. When combined with the reduced pain of paying, these urgency tactics form a perfect storm that encourages quick, emotional purchases rather than thoughtful financial decisions. The combination is particularly effective because it simultaneously minimizes the negative feeling of spending while maximizing the positive feeling of immediate ownership. You get the full dopamine hit of acquiring something new right now, while the financial consequences are pushed into the future and divided into less painful chunks. This decoupling of pleasure and pain is a fundamental principle in behavioral economics. When you separate the enjoyment of consumption from the pain of payment, people naturally tend to consume more. BNPL has mastered this separation, creating what experts call a more gratifying shopping experience, specifically because it reduces the financial pain signals your brain would normally receive. What's particularly interesting is how these companies have spent millions studying exactly when your financial willpower is weakest. They know precisely how to frame payments to bypass your internal spending alarm system. The scary part? Even knowing these tricks won't necessarily make you immune to them. They work on a level that's often below conscious awareness. Take a moment to consider your own BNPL purchases. Were they carefully planned financial decisions, or were they impulse buys that suddenly felt more accessible? Did you end up spending more than you initially intended? For most people, the answer reveals how effectively these psychological triggers work. For younger consumers and those with limited financial resources, these psychological effects are even more powerful. The ease of obtaining BNPL loans, often without rigorous credit checks, makes the barrier to purchase incredibly low. When combined with the reduced pain of paying, this accessibility creates a particularly potent combination that can lead to serious overspending. One consumer psychology researcher explained it perfectly. BNPL doesn't just make payments easier. It fundamentally changes how consumers perceive value and affordability. The same person who would balk at a $200 purchase might readily accept 4 payments of $50, even though mathematically nothing has changed. What's happening behind the scenes is a sophisticated form of mental accounting. Your brain naturally categorizes spending into different mental buckets, and BNPL exploits this by making each smaller payment feel like it belongs in your small expenses bucket, rather than your major purchase bucket, even though collectively that's exactly what it is. This psychological reframing is so effective that many consumers are feeling less constrained financially when using BNPL, leading them to make larger purchases and add more items to their carts. The temporary feeling of financial freedom actually encourages greater financial commitment. Who's really using BNPL? The demographics of digital debt. That temporary feeling of financial freedom isn't just experienced equally by everyone. In fact, the demographic patterns of who's clicking those BNPL buttons reveal something much deeper about our financial system. Looking at the data, one pattern jumps out immediately. BNPL services aren't being used uniformly across all groups. Black and Hispanic women use these payment plans at more than double the rate of their white counterparts. About 1/4 of Black and Hispanic women have used BNPL services, compared to just 11% of white women and an even lower 8% of Asian women. But why such striking differences? These numbers aren't random. They reveal fundamental inequalities in our financial system. When we dig deeper into who's using BNPL, the picture becomes clearer. It's not just about racial demographics. There's a strong correlation with income and credit access too. Federal Reserve research shows that consumers with credit scores below 600 are turning to BNPL at dramatically higher rates. 23% of these consumers have used BNPL at least once. Compare that to those with excellent credit scores above 800, where only 2.8% have used these services. This stark contrast tells us something crucial. BNPL services aren't just random payment options. They're filling a gap for people who struggle to access traditional financial services. Women overall are nearly 60% more likely to use BNPL than men, with 22.7% of women reporting usage compared to 14.3% of men. This gender gap isn't accidental either. BNPL marketing often targets products and services that appeal to female consumers, and many women report using these services to manage household budgets in ways that traditional credit doesn't accommodate. Age plays a significant role too. Nearly half of BNPL users are under 36 years old. This younger demographic is much more likely to cite lack of credit history as their reason for turning to installment payments. Many young adults simply haven't had the opportunity to build substantial credit histories yet, making traditional credit cards harder to obtain. The financial vulnerability patterns continue when we look at income levels. The Consumer Financial Protection Bureau found that nearly 73% of BNPL users earn less than $75,000 annually. This concentration among lower and middle-income households suggests these services are filling a need for people who don't have large cash reserves for unexpected or larger purchases. But here's what makes these statistics truly concerning. The CFPB discovered that 63% of BNPL borrowers had multiple, simultaneous loans at some point during the year. This loan stacking was particularly common among consumers with lower credit scores, creating a potentially dangerous cycle of payments that becomes increasingly difficult to manage. Think about what this means in practical terms. If you're a young Black or Hispanic woman with a moderate income and limited credit history, traditional financial systems often don't serve you well. Banks may charge you higher interest rates or deny credit altogether. Credit card companies might offer only small credit limits with harsh penalties. In this context, BNPL appears as an accessible alternative, a financial lifeline when few other options exist. This accessibility explains why 55% of BNPL users report using these services because it was the only way they could afford their purchases. When traditional doors are closed, these seemingly friendly payment options become one of the few paths forward. BNPL providers know exactly who their services appeal to, and their marketing reflects this awareness. Their campaigns heavily target younger audiences through social media platforms and influencer partnerships. These marketing approaches specifically resonate with demographics that have grown up in a digital world but may lack financial literacy or access to traditional credit. Scroll through TikTok or Instagram and you'll find countless influencers casually mentioning how they just split it with Afterpay or used Klarna to grab this outfit. These seemingly innocent endorsements normalize BNPL use among specific demographic groups, making it seem like a standard risk-free way to shop rather than a form of debt. The targeting extends beyond social media. BNPL buttons appear more frequently on websites selling products that appeal to specific demographics. Fast fashion retailers, beauty brands, and home goods stores frequently promote these payment options prominently, knowing their customer base often includes the very groups most likely to use installment payments. What's particularly troubling about these patterns is how they reflect and potentially reinforce existing financial inequalities. Groups that historically have had less access to wealth-building opportunities and traditional financial services are now being offered a financial product that, while providing short-term accessibility, may create long-term financial vulnerability. This isn't to say that BNPL services can't be useful tools when used carefully. However, the concentration of usage among already financially vulnerable populations raises important questions about whether these services are truly helping to bridge financial gaps or potentially widening them. For many users, BNPL represents the only way to make necessary purchases without falling behind on essential bills. When your car needs immediate repairs so you can get to work, or when your child needs a new laptop for school, BNPL can seem like a reasonable solution if you're juggling financial priorities and traditional credit isn't available. But we can't ignore the systemic issues that create these disparities in the first place. Black and Hispanic consumers, particularly women, continue to face significant barriers in traditional banking and credit systems. Historical practices like redlining may have been officially outlawed, but their effects continue in the form of credit score disparities, banking deserts in minority communities, and higher rejection rates for traditional loans. Young adults face their own challenges. Many are entering adulthood with student loan debt, and in a housing market that makes building wealth through homeownership increasingly difficult. Traditional credit systems often penalize them for their lack of credit history, creating a catch-22 where you need credit to get credit. This is the uncomfortable reality behind those convenient payment buttons. BNPL services have identified where traditional financial systems have failed specific demographics, and they've positioned themselves as the solution, all while their business models depend on at least some percentage of users falling behind on payments. The story these demographics tell isn't just about individual consumer choices. It's about how our financial systems continue to create uneven playing fields. When nearly a quarter of Black and Hispanic women are turning to BNPL, while only 11% of white women do the same, we're seeing the effects of systemic financial inequality play out in real time through consumer behavior. For anyone using these services, understanding these patterns is crucial. If you're in one of these higher usage demographic groups, it doesn't mean BNPL is automatically bad for you, but it does mean you might be more aggressively targeted by these services, and you should be the hidden costs, fees, penalties, and credit consequences. Those multiple payment plans you're juggling come with a hidden cost that most users never see coming until it's too late. Remember that bold 0% interest claim plastered across every BNPL checkout button? Turns out there's a reason 63% of BNPL borrowers end up with multiple loans, and it has everything to do with what happens when you miss a payment deadline, even by a single day. That zero interest promise is front and center in all BNPL marketing. No interest, ever. Interest-free payments. These catchy phrases make BNPL seem like the smart shopper's secret weapon. But like any financial product that seems too good to be true, there's more to the story hiding in the fine print that most shoppers never bother to read. While BNPL services boldly advertise their interest-free payments, they're much quieter about what happens when things don't go exactly as planned. Miss a payment by just one day, and suddenly that free service starts looking a lot more expensive. Let's break down what really happens behind that 0% marketing. Afterpay, one of the biggest players in the game, charges late fees that can reach up to $10 for purchases under $40. For orders over $40, they hit you with an initial $10 fee, and the charges can climb to a maximum of 25% of your order amount, or $68, whichever comes first. That's a significant chunk of your original purchase. Klarna isn't much better, imposing a late fee of up to $7 per missed payment. And Zip, formerly known as QuadPay, charges up to $10 per purchase when you don't pay on time. These aren't just minor inconveniences, they're substantial penalties that can quickly transform your great deal into a financial headache. To put this in perspective, imagine buying a $100 pair of shoes with a BNPL option. Miss just 2 of your 4 scheduled payments, and with repeated late fees, your $100 purchase could easily balloon to $120, $130, or more. Suddenly, that zero-interest deal has essentially turned into a very high-interest loan. One consumer's experience highlights just how quickly these costs can add up. After missing a payment by just one day, literally 24 hours, they were slapped with a $29 late fee. As they pointed out in their complaint, that amount was equivalent to the interest they were specifically trying to avoid by choosing a BNPL option in the first place. That interest-free promise evaporated overnight. What's particularly concerning is how widespread these issues are. Consumer Reports found that 28% of BNPL users reported having problems with refunds and disputes. Many of these consumers admitted they had no idea about the potential fees associated with missed payments when they signed up. The marketing is all about the benefits, while the drawbacks remain buried in terms and conditions that few people ever read. The consequences don't stop at late fees either. When BNPL services first launched, many promoted the fact that they didn't perform credit checks or report to credit bureaus, making them appear even more consumer-friendly. But here's what they don't advertise. Missed payments on BNPL loans can lead to collections actions, which absolutely can impact your credit score. Imagine being sent to collections over a $50 purchase you split into 4 payments. It sounds extreme, but it happens regularly. And once an account goes to collections, that negative mark can stay on your credit report for up to 7 years, all from a shopping spree you thought you were handling responsibly. The data shows these aren't isolated incidents. The CFPB's research found that BNPL borrowers are more likely to hold multiple simultaneous loans, with 63% of borrowers taking out multiple loans at some point during the year. When you're juggling multiple payment plans across different BNPL providers, each with their own payment schedules and late fee structures, it's incredibly easy to miss a payment and get hit with fees. The financial strain extends beyond just the direct late fees. Studies have found that BNPL users incurred 4% more overdraft charges and faced 1.1% higher credit card interest rates compared to people who don't use these services. These are hidden costs that never show up in the BNPL marketing materials, but represent real money coming out of consumers' pockets. The average BNPL loan size hovers around $135, which might not seem like much. But when the average late fee charged by these providers is approximately $7, we're talking about a penalty that represents more than 5% of the purchase price. And that's just for a single missed payment. Miss multiple payments across multiple loans, and you're looking at serious money. It's not surprising that consumer complaints to the Consumer Financial Protection Bureau and Better Business Bureau have surged in recent years. Many users express frustration over unexpected charges and the difficulties they face when trying to get refunds. The problem is so widespread that regulators are starting to take notice and investigate these practices. What makes this situation particularly troubling is the disconnect between how BNPL services market themselves and how they actually operate. They position themselves as consumer-friendly alternatives to credit cards, emphasizing the absence of interest and the simplicity of 4 easy payments. But in reality, they've simply replaced interest with late fees and penalties that can be just as costly, or even more so than credit card interest would have been. So how does a 0% interest payment option lead to serious financial trouble? It's a perfect storm. The combination of easy approval, minimal upfront disclosure of fees, multiple payment deadlines to track, and steep penalties for missing those deadlines. Add in the fact that many consumers use multiple BNPL services simultaneously, and you have a recipe for financial confusion and unexpected costs. The most insidious part is how these services create a false sense of affordability. When something is marketed as interest-free, consumers naturally assume it's the less expensive option. But when you factor in the potential for late fees, collection actions, credit score damage, and the increased likelihood of overdraft fees, the true cost can far exceed what you'd pay using traditional payment methods. For anyone using BNPL services, understanding the full fee structure is absolutely essential. Before clicking that tempting checkout button, take the extra minute to read the fine print. Set up automatic payments if possible to avoid missing deadlines. And most importantly, keep track of how many BNPL obligations you have at any given time, because the companies certainly aren't doing it for you. The credit score paradox: why BNPL can hurt your financial future. Those hidden fees aren't the only thing BNPL companies keep quiet about. What if I told you these services operate in a credit score twilight zone, where your on-time payments earn you absolutely zero credit, but your mistakes can haunt your financial record for up to 7 years? The imbalance is staggering, and it's about to get even more complicated. When you see that tempting Pay in 4 button, it often comes with reassuring messages like, no impact on your credit score, or just a soft credit check. This marketing is incredibly effective at making BNPL seem like a consequence-free option. After all, who wouldn't want to spread out payments without affecting their credit? Here's where it gets tricky. While it's technically true that the initial approval process typically won't affect your credit score, what happens after you click that button is an entirely different story. The credit impact of BNPL isn't about getting approved, it's about what happens when payments go sideways. Currently, most BNPL providers don't report your on-time payments to credit bureaus. That means all those payments you diligently make, they're essentially invisible to the credit system. Unlike credit cards or traditional loans where consistent payments help build your credit history, BNPL gives you zero credit for good behavior. You could make hundreds of on-time BNPL payments and your credit score wouldn't budge an inch. But miss a payment, that's when things change dramatically. A study found that 15% of BNPL users with at least one late payment reported that this negative information was reflected on their credit report. These missed payments can be sent to collections agencies, which absolutely will report to credit bureaus, creating negative marks that stick around for years. The credit bureaus themselves recognize this problem. Equifax, Experian, and TransUnion are actively working on new systems specifically designed to include BNPL loans in credit reports. As of May 2024, the Consumer Financial Protection Bureau has issued an interpretive rule requiring BNPL providers to report these loans, though the implementation details are still being finalized. This creates what I call the BNPL credit paradox. You get all of the risk with none of the reward. While this reporting gap exists, you're essentially in a no-win situation. Do everything right and gain nothing. Make one mistake and potentially lose big. What makes this especially concerning is who typically uses these services. Research shows that 37% of BNPL users have credit scores below 620, significantly higher than the general population. These are precisely the consumers who would benefit most from building positive credit history. Yet, BNPL offers them no path to do so. There's another hidden credit danger that almost no one talks about. When you stack multiple BNPL loans across different platforms, traditional lenders viewing your credit profile might see something that raises serious red flags. A pattern that looks suspiciously like credit cycling. Credit cycling occurs when someone repeatedly maxes out credit, pays it off, then immediately maxes it out again. A behavior that signals financial distress to lenders. Multiple BNPL accounts with overlapping payment schedules can create a similar pattern, even if you're making all payments on time. To a mortgage lender reviewing your application, these recurring short-term loans might suggest you're struggling to manage cash flow. Speaking of mortgages, consider this scenario. You're ready to buy your first home, you've saved for a down payment, and your income qualifies you for the loan. But the underwriter notices numerous BNPL accounts on your credit report once they start being reported. Even if they're all in good standing, these obligations reduce your debt-to-income ratio, potentially decreasing how much you can borrow, or worse, disqualifying you entirely. The CFPB's findings paint an even more troubling picture. Their research shows that BNPL users experience higher rates of financial stress, with BNPL users reporting more missed payments and overdraft fees compared to non-users. This suggests that people using these services may already be financially vulnerable, making the asymmetric credit reporting even more problematic. When we look at the demographic breakdown, the issue becomes even more concerning. BNPL usage is particularly high among younger consumers, with 28% of BNPL purchases made by borrowers aged 18 to 24. These young adults are at a critical stage for building credit history, yet the credit-building opportunity is completely missed with BNPL. The regulatory landscape is evolving, though. The CFPB is actively working to ensure BNPL providers follow consumer protection laws similar to those governing credit cards. This shift could eventually lead to more comprehensive reporting practices that capture both positive and negative payment behaviors. Until then, consumers are caught in an unfair system where only negative information flows to credit bureaus. Think about how absurd this would be in any other context. Imagine if your professor only recorded your failed tests but never your passing grades. Or if your employer documented every mistake but never your accomplishments. That's essentially how BNPL currently operates in the credit reporting world. This one-sided reporting creates a particularly cruel irony for consumers who choose BNPL specifically to avoid credit card debt and protect their credit scores. They've made what seems like a responsible choice, only to discover it offers none of the benefits of traditional credit while still carrying many of the risks. For consumers with established credit, this asymmetric risk might be manageable. But for those with thin credit files or rebuilding after financial setbacks, the stakes are much higher. A single collections report from a missed BNPL payment could significantly set back their credit journey. And let's be clear, these missed payments aren't always the result of irresponsibility. The complex web of payment schedules across multiple BNPL providers makes keeping track exceptionally difficult. Add in automatic withdrawals that might hit on days when your account balance is low, and even the most organized person can slip up. The CFPB report highlighted another troubling pattern. BNPL borrowers tend to have higher balances on other unsecured credit lines, including credit cards. This indicates they may be financially stretched thin, using BNPL as just one piece in a precarious debt juggling act. When your financial situation is already delicate, the last thing you need is a surprise credit score drop. Looking forward, the inclusion of BNPL data in credit reports could eventually be positive if implemented properly. Comprehensive reporting that captures on-time payments could help consumers build credit while using these services. But until that system is fully established, BNPL users are operating in a credit reporting blind spot that disproportionately captures negative information. For anyone considering using BNPL, understanding this credit score risk is crucial. While the no credit impact marketing might be technically accurate for the approval process, it presents an incomplete and potentially misleading picture of how these services interact with your broader financial profile. The fundamental question every consumer should ask is, why would you take on financial obligations that offer no credit building upside, but still carry significant credit damaging downside? It's like playing a game where you can only lose points but never gain them. The deck is stacked against you from the start. The regulatory Wild West, missing consumer protections. Playing a game where the odds are stacked against you is one thing, but what if you suddenly discovered the game had no official rules? That's the reality of the buy now, pay later universe, until very recently. While credit cards have operated under decades of consumer protection laws, BNPL services have been functioning in a regulatory blind spot that left users vulnerable exactly when they needed help most. Think about the last time you used a credit card. Whether you realized it or not, you were protected by a robust framework of federal laws. The Truth in Lending Act, the Fair Credit Billing Act, and other regulations give credit card users specific rights when things go wrong. If your order arrives damaged, if you're charged incorrectly, or if a merchant refuses to honor their return policy, you have legal backing to dispute these issues. But what happens when your $500 laptop purchased through a BNPL service arrives with a cracked screen, but the merchant claims it was your fault? Or when you return an item but keep getting charged anyway? Until recently, you were pretty much on your own. This regulatory gap created real problems for real people. More than 13% of all BNPL transactions involve a return or dispute. That's millions of situations where consumers needed protection but found themselves in uncharted territory instead. Picture ordering furniture through a BNPL service, returning it because it arrived damaged, but continuing to receive payment demands while the merchant and BNPL provider point fingers at each other. Without clear rules governing who's responsible, consumers have been caught in a frustrating game of corporate hot potato. The Consumer Financial Protection Bureau, CFPB, identified this exact problem in their analysis of the BNPL industry. They found that most BNPL providers weren't following the same dispute resolution procedures required by the Truth in Lending Act. When a dispute arose, consumers often couldn't freeze their payments while the issue was being resolved, something credit card users take for granted. Instead, many reported being sent to collections over disputed purchases, damaging their credit despite their best efforts to resolve the situation properly. Another critical protection missing from the BNPL landscape was standardized disclosures. Credit card companies must provide clear, consistent information about interest rates, fees, and terms in a format that allows consumers to easily compare options. BNPL services, by contrast, have been presenting their terms in wildly different formats, often burying important details in lengthy terms of service agreements. This lack of standardization has made it difficult for consumers to understand exactly what they're signing up for, or to make informed comparisons between different BNPL options. The absence of these protections wasn't an oversight. It was a feature of the BNPL business model. By positioning themselves as payment methods rather than credit providers, BNPL companies found a loophole that allowed them to avoid regulations that traditional lenders must follow. This regulatory arbitrage gave them a competitive advantage but left consumers exposed. Some states tried to fill the gap on their own. California, for example, classified BNPL products under their California financing law, requiring providers to obtain licenses and comply with state consumer credit regulations. But this piecemeal approach created a confusing patchwork of rules that varied depending on where you lived, hardly the consistent protection consumers need in an increasingly digital marketplace. Internationally, other countries moved more quickly than the US to close these regulatory gaps. The European Union began addressing BNPL through its Consumer Credit Directive, recognizing that regardless of how these services marketed themselves, they were functionally extending credit and should be regulated accordingly. The good news is that the regulatory landscape is finally changing. On May 22, 2024, the CFPB issued a landmark interpretive rule confirming that BNPL lenders are classified as credit card providers under federal law. This classification means BNPL companies must now provide consumers with key legal protections similar to those that have long applied to conventional credit cards. What does this mean for you? For starters, you'll now have the right to dispute charges and withhold payment while disputes are being resolved. BNPL providers must investigate billing errors when you report them and provide clear explanations of their findings. They must also offer grace periods before reporting late payments and limit your liability for unauthorized charges. This regulatory shift comes after years of mounting consumer complaints. A staggering 28% of BNPL users reported problems like being overcharged or facing impossible return processes. The CFPB's action signals a recognition that while innovation in financial services is valuable, basic consumer protections shouldn't be sacrificed in the name of disruption. But questions remain about how effectively these new protections will be implemented and enforced. Will BNPL companies fully comply with these regulations, or will they find new loopholes? Will consumers know their rights and how to exercise them? And what about other aspects of BNPL that still lack oversight, like the impact of multiple loans on financial stability? The CFPB's rule is a significant step forward, but it's worth noting that it took years of consumer harm before regulators caught up to the rapid growth of BNPL services. This lag time between innovation and regulation highlights a broader challenge in financial services. How do we encourage beneficial innovation while ensuring consumers aren't harmed in the process? For now, if you're using BNPL services, it's important to understand that while you have more protections than before, the implementation of these rules is still evolving. Document everything related to your purchases. Take screenshots of order confirmations, keep all emails and text messages about your purchase, and note the dates and names of anyone you speak with about issues that arise. If you need to return an item, follow the return instructions precisely and get tracking information for your return shipment. If you encounter problems, know that you now have the right to dispute charges with your BNPL provider directly. Put your dispute in writing email is fine, and be specific about the issue. If the BNPL company doesn't resolve your problem, you can file a complaint with the CFPB through their website. Remember, too, that these new protections only cover certain aspects of BNPL usage. They don't address other risks like overextension from multiple loans or the potential impact on your credit score. The regulatory framework is still evolving, and there may be gaps that leave you vulnerable in ways you don't expect. The transition from regulatory Wild West to properly regulated financial service is underway for BNPL, but it's not complete. While these new protections represent real progress, they're arriving after millions of consumers have already experienced problems. The lesson here isn't just about BNPL specifically, but about approaching any new financial product with caution. The debt stacking crisis, how multiple BNPL loans create a dangerous cycle. New regulations might protect you from billing disputes, but they can't save you from the mathematical nightmare of debt stacking. Picture this: 5 different payment schedules from 5 different companies, all hitting your bank account at different times. This isn't a hypothetical scenario. It's the financial juggling act sending thousands of BNPL users into a tailspin every day. When you use a single BNPL service, keeping track of your payments seems straightforward. But what happens when you add another, and another, and then 2 more? Suddenly, you're caught in what financial experts call loan stacking, the practice of taking multiple BNPL loans across different providers simultaneously. Here's where things get messy. Each BNPL provider operates in its own silo. Klarna has no idea you have active loans with Afterpay. Affirm can't see your zip balance. Each company only sees their small piece of your financial puzzle, creating a dangerous blind spot in your overall debt picture. The numbers from the Consumer Financial Protection Bureau paint a troubling picture. Not only do roughly 2/3 of BNPL borrowers have multiple loans running at the same time, but 1/3 of users spread those loans across multiple different providers. This fragmentation makes it nearly impossible to get an accurate picture of your total obligations. Think about what this means practically. Let's say you've made purchases using 4 different BNPL services. Each one splits your payment into 4 installments over 6 weeks. That's 16 total payments hitting your account, not in a neat, organized schedule, but in a chaotic stream of withdrawals that can happen any day of the week. Monday might be Afterpay, Wednesday could be Klarna, Friday might be Affirm, and then Sunday brings Zip. The next week, it starts all over again. What makes this especially dangerous is how the human brain processes this scattered payment schedule. When payments are broken into smaller chunks and spread across different dates, our minds struggle to combine them into a total financial burden. It's like trying to visualize the size of a jigsaw puzzle while only looking at individual pieces. Nearly impossible. One consumer shared their experience with this debt web. I honestly lost track of how many BNPL accounts I had open. Between my Klarna, Affirm, and Afterpay accounts, I had about 12 different payment schedules running simultaneously. I started overdrafting my checking account because I couldn't keep track of when all these payments were hitting. What started as a way to budget turned into a complete financial disaster. This constant stream of withdrawals creates a particularly insidious form of financial stress. Traditional loans typically have one monthly payment on a fixed date. You can plan for it. With multiple BNPL accounts, you're facing a barrage of unpredictable withdrawals that make budgeting almost impossible. Your bank account becomes a revolving door where money flows out before you can even register it's gone. The problem gets worse when you consider that most BNPL providers don't communicate with credit bureaus. While this is marketed as a benefit, no impact on your credit score. It actually creates a dangerous information gap. A traditional lender can't see your complete BNPL debt load when evaluating your loan application. You might appear to have available spending capacity when, in reality, your disposable income is already committed to BNPL payments for weeks or months ahead. What's even more concerning is how BNPL use correlates with other forms of debt. The CFPB discovered that BNPL borrowers tend to carry higher balances on other unsecured credit lines like credit cards. This suggests many users are already stretched financially before adding multiple BNPL loans to their debt portfolio, a a classic example of using new debt to manage existing financial pressures. And the trend is worsening. Between 2021 and 2022, the average number of BNPL loans per borrower increased from 8.5 to 9.5. This wasn't just more people using BNPL. This was existing users taking on more loans, creating increasingly complex webs of payment obligations. The mathematical reality of loan stacking becomes particularly dangerous during financial emergencies. Imagine you face an unexpected car repair or medical bill, and suddenly those 16 different BNPL payments that seemed manageable become completely impossible to cover. With your cash flow already committed weeks in advance, you have no financial cushion to absorb unexpected expenses. This fragmentation of debt across multiple platforms explains a troubling statistic. 55% of BNPL users report that these services help them purchase items they otherwise couldn't afford. But this raises a critical question. If you can't afford something as a single purchase, does splitting it into payments actually make it affordable, or does it just postpone the financial reckoning? The financial technology that makes BNPL so convenient, instant approval, minimal credit checks, seamless checkout integration, actually works against consumers by making it too easy to accumulate obligations across multiple platforms. The very features designed to remove friction from the purchasing process also remove the natural pause points that might otherwise make us reconsider an unwise purchase. Think about the psychology at work. When you apply for a traditional loan, there's typically a formal application process, a waiting period, and a distinct moment when you sign loan documents. These steps create natural reflection points. With BNPL, adding another payment plan is as simple as clicking a button during checkout. No waiting, no paperwork, no moment of reflection about how this new obligation fits into your overall financial picture. This debt stacking phenomenon becomes particularly problematic for financially vulnerable consumers. The New York Fed found that while 72% of financially stable users made multiple BNPL purchases in a year, an alarming 89% of financially fragile users did the same. The very people who can least afford to juggle multiple payment obligations are the ones most actively accumulating them. What's even more troubling is how BNPL providers encourage this behavior. Their business models thrive on repeat usage. Many platforms send regular promotional emails highlighting new products available through their service. Some even offer incentives like discounts or rewards for making additional purchases before you've paid off existing ones. The message is clear. Keep buying, keep splitting payments, don't worry about the total. The lack of transparency across the BNPL ecosystem creates a perfect storm for financial confusion. When traditional lenders evaluate loan applications, they can see your existing credit obligations through credit bureau reporting. But since many BNPL providers don't report to credit bureaus, there's no centralized system tracking how many BNPL loans you've taken. This information gap means no one, not even you, has a complete picture of your financial commitments. Consider how this differs from credit cards. While credit cards certainly carry risks, they at least consolidate your debt in one place with a single monthly statement showing your total balance. With multiple BNPL accounts, you might need to log into 5 different apps just to calculate your outstanding obligations, an extra step most busy consumers simply don't take. The bi-weekly payment structure common to many BNPL services compounds this problem. Unlike monthly bills that align with typical paycheck cycles, these staggered bi-weekly payments create a perpetual state of financial obligation that can quickly become overwhelming. One missed paycheck can trigger a cascade of missed payments, late fees, and declined transactions across multiple platforms simultaneously. Red flags. Signs you're heading for BNPL trouble. When that cascade of missed payments hits, it's usually too late. You're already in the danger zone. But what about the early warning signs that could save you from financial disaster? If you're using BNPL for groceries instead of gadgets, or feeling that knot in your stomach every time a payment date approaches, your relationship with buy now, pay later might already be toxic. The truth is, BNPL problems rarely appear overnight. Like most financial challenges, they creep up gradually, building momentum until they suddenly feel overwhelming. By the time you're drowning in payment notifications, you're already deep in the quicksand. What makes BNPL particularly tricky is how normal it can feel to have multiple small payments running simultaneously, until suddenly, it's not manageable anymore. Let's talk about the first major red flag, using BNPL for essentials rather than occasional splurges. When you start putting groceries, gas, or utility bills on payment plans, you've crossed an important psychological line. These necessities were traditionally paid for with cash or debit cards because they're recurring expenses that make up your basic cost of living. When you need to split these payments, it's a clear indicator that your monthly cash flow can't cover your basic needs, a serious financial warning sign. Think about it. BNPL was initially designed for discretionary purchases like electronics or fashion. When you're financing toilet paper or milk, you're not using these services strategically. You're using them to survive until your next paycheck. This behavior shift from wants to needs is often the first step toward a problematic relationship with these services. The second warning sign is closely related: taking out new BNPL loans specifically to bridge the gap before payday. This behavior pattern transforms these services from occasional payment tools into financial crutches. When you find yourself thinking, "I just need to make it to Friday," and opening a new BNPL account to cover basic expenses, you're caught in what financial experts call the paycheck-to-paycheck trap. This pattern is particularly common among younger consumers and those with lower incomes who may have limited financial buffers. The immediate relief of being able to buy necessities feels like a solution, but it's actually creating a deeper problem. You're essentially borrowing from your future self, and that debt compound effect can quickly spiral out of control. The third red flag might be the most insidious because it sneaks up on you: losing track of how many active BNPL loans you have across different providers. With dozens of BNPL companies operating independently, each with their own app and payment schedule, it's surprisingly easy to lose count of your total obligations. The statistics are startling. 63% of BNPL users had multiple simultaneous loans at some point. Let that sink in. Nearly 2/3 of users are juggling multiple payment plans at once. What makes this especially concerning is that 41% of these users reported experiencing problems with their loans. Without a centralized system tracking your total BNPL debt, you might feel like each individual payment is manageable, while your overall financial picture becomes increasingly precarious. Try this quick exercise. Without checking your phone, can you name every active BNPL loan you currently have? Can you state the exact payment amounts and dates for each one? If you hesitated or realized you're not entirely sure, that's a serious warning sign. The fourth red flag is a behavior pattern that might seem minor but actually reveals a deeper problem: regularly rescheduling payments or incurring late fees. According to research, about 18% of BNPL users have made at least one late payment, with higher rates among younger and lower income users. It's easy to dismiss an occasional missed payment as a simple scheduling error, but patterns don't lie. Consistently pushing back due dates or accepting late fees means one of two things. Either you're not taking these financial obligations seriously, a financial mindset problem, or, more likely, you simply don't have enough income to cover your expenses, a fundamental budgeting problem. Think of it like constantly hitting the snooze button on your financial alarm clock. Each reschedule might buy you a little time, but the underlying issue doesn't go away. It usually gets worse as late fees accumulate, and your next payday becomes increasingly burdened with past obligations. The fifth and final warning sign is perhaps the most telling because it's not about the numbers. It's about your emotional relationship with money. Feeling anxiety or stress about upcoming BNPL payment dates. Financial stress manifests physically. That pit in your stomach when you get a payment notification, the urge to avoid opening your banking app, or the relief you feel when a payment processes without overdrafting your account. These emotional responses are your body's way of telling you something's wrong with your financial situation. A survey revealed that 30% of BNPL users reported being completely unaware of the potential late fees or interest charges when they first used these services. This lack of clarity contributes significantly to financial anxiety, especially when 11% of users reported missing at least one payment. The gap between what consumers expect and the reality of these services creates a perfect environment for financial stress. When used properly, financial tools shouldn't generate anxiety. They should reduce it. If you're experiencing stress about BNPL payments, it's worth asking yourself why. Is it because you've overextended? Because you're using these services to cover expenses your income can't support? Or because you've lost control of your total debt picture? Financial counselors consistently recommend that consumers step back and honestly assess their BNPL usage patterns. This self-assessment isn't about judgment, it's about awareness. Are you using these services occasionally for planned purchases you could afford anyway, but prefer to spread out? Or have they become a necessary part of your monthly survival strategy? If you recognize any of these warning signs in your own financial life, it might be time to reconsider your relationship with buy now, pay later services. The psychological impact of BNPL can lead to impulsive spending that creates cycles of debt, particularly among financially vulnerable consumers. Many users report buying more than they would have if they'd had to pay the full amount up front. A clear indication that these services are affecting spending behavior in potentially harmful ways. Ask yourself, when was the last time you made a purchase with BNPL that wasn't already in your budget? How often do you check your balance across all BNPL accounts? Does thinking about upcoming payments make you anxious? Your honest answers to these questions can reveal whether your use of these services is strategic or better alternatives, smarter ways to manage purchases and build credit. If those tough questions about your BNPL habits have you reconsidering your relationship with these services, you're definitely not out of options. The financial world offered ways to manage large purchases long before Afterpay and Klarna appeared on checkout pages. And most of these traditional methods actually come with stronger consumer protections and fewer hidden traps. Let's be honest about what makes BNPL appealing. Spreading out payments can genuinely help with cash flow management. But what if you could get that same benefit without sacrificing your financial health? Here are 5 smarter alternatives that might leave you in a much better position. First up, traditional credit cards with 0% introductory APR offers. While credit cards often get a bad rap, they can be powerful financial tools when used strategically. Many cards offer zero interest periods ranging from 12 to 21 months for larger necessary purchases. Unlike BNPL's short payment windows that can create cash flow crunches, these longer terms give you breathing room to pay down balances without accruing interest. Plus, you'll benefit from robust consumer protections that allow you to dispute charges and demand refunds, rights that aren't consistently available with BNPL services. Think about that kitchen appliance you need to replace, or that necessary car repair. Instead of cramming 4 payments into 6 weeks, you could spread that same amount over a year or more without paying a penny of interest, provided you make your minimum payments on time. This approach gives you significantly more flexibility than BNPL's rigid payment schedule. The second alternative might sound old-fashioned, but it's making a comeback for good reason. Dedicated savings accounts for planned purchases. Remember when people used to save before buying things? This save first, buy later approach has stood the test of time because it works. By setting up a dedicated savings account for specific purchase goals, you're effectively creating your own interest-earning payment plan, but one that works in reverse. Instead of owing money after making a purchase, you're building up funds beforehand. Many online banks now offer specialized savings accounts that let you create multiple savings buckets for different goals. The best part? This method actually builds wealth instead of creating debt, as your money earns interest while you save. When you finally make that purchase, you'll own it outright with zero financial stress afterward. For larger necessary expenses, credit union personal loans offer a third alternative with significant advantages over BNPL. Credit unions typically provide fixed-term loans with transparent costs and predictable payment structures. Unlike BNPL's sometimes confusing terms, credit union loans clearly state the total cost of borrowing upfront, including any fees and interest. Since credit unions are member-owned financial cooperatives, they typically offer lower interest rates than traditional banks or finance companies. The application process might take slightly longer than an instant BNPL approval, but that extra time creates an important pause for reflection about the purchase, something BNPL deliberately eliminates to encourage impulse buying. Plus, making on-time payments on a personal loan builds your credit score, creating a positive long-term financial benefit that most BNPL services don't provide. The fourth alternative brings us back to basics: cash budgeting methods like the envelope system. This approach helps manage spending by allocating specific amounts of cash for different budget categories. While you don't literally need to use cash envelopes, though some people find the physical aspect helpful, the principle remains powerful in the digital age. By setting clear spending limits for categories like clothing, entertainment, and home goods, you become much more conscious of your purchasing decisions. Many budgeting apps now offer digital envelope systems that help you track category spending in real time. This increased awareness naturally reduces impulse purchases, the very behavior BNPL services are designed to encourage. When you know exactly how much you have left in your clothing budget for the month, you're less likely to be swayed by that tempting BNPL button at checkout. The fifth alternative, secured credit cards, offers a particularly good option for those working to build credit while preventing overspending. These cards require a cash deposit that serves as your credit limit, making it physically impossible to spend more than you can afford. Unlike BNPL, which can lead to multiple overlapping payment obligations, a secured card provides a clear view of your total debt at any moment. The beauty of secured cards is that they report to all three major credit bureaus, helping you build credit history with responsible use. Once you've established good payment patterns, many card issuers will return your deposit and transition you to a traditional credit card with a higher limit. This creates a clear pathway to better financial options, unlike BNPL services that can trap you in a cycle of perpetual payments without building credit history. What makes these alternatives particularly valuable is that they all contribute to your long-term financial health, rather than simply enabling purchases. Traditional credit cards build your credit score when used responsibly. Savings accounts earn interest while teaching delayed gratification. Credit union loans provide structured borrowing with community benefits. Cash budgeting methods increase spending awareness. Secured cards build credit while preventing overspending. The Consumer Financial Protection Bureau's research has consistently found that BNPL users often face higher rates of financial distress compared to those who use more traditional financing methods. This suggests that responsible alternatives like credit cards and personal loans may actually be more beneficial in the long run, despite BNPL's flashy marketing claims. Financial experts repeatedly emphasize that consumers should prioritize building savings and using budgeting tools to manage finances effectively, rather than relying on BNPL services that can lead to debt accumulation without building financial strength. The strongest financial strategies don't just enable purchases, they improve your overall financial position with each transaction. What's particularly interesting is that all these alternatives come with stronger consumer protections than BNPL services. The ability to dispute charges, demand refunds, and access clear terms and conditions creates a safer environment for managing your purchases. While BNPL companies have recently faced increased regulatory scrutiny, traditional financial services have operated under robust consumer protection laws for decades. Using BNPL Responsibly, a survival guide for the digital shopper. Despite the risks we've covered, some consumers still find themselves drawn to that tempting BNPL button at checkout. If you're determined to use these services, there's a crucial distinction between those who get burned and those who maintain control. While the statistics paint a concerning picture, the reality is that 89% of BNPL users do manage to make all their payments on time. So what's their secret? And could you join that successful group? Let's be real, BNPL isn't disappearing from checkout pages anytime soon. If you absolutely must use these services, there's a specific playbook that can help you avoid the debt spiral that traps so many others. Think of this as your survival guide in the BNPL jungle. First rule of responsible BNPL usage: only use these services for plan necessary purchases that you've already budgeted for. This might seem obvious, but it's the foundation of safe BNPL use. The moment you start using BNPL for impulse purchases or things you hadn't planned to buy, you've already stepped onto the slippery slope. Imagine you've been saving for a new laptop for work, and you're just a paycheck away from the full amount. Using BNPL in this scenario makes sense. You've already committed to the purchase, you know it fits your budget, and you're simply spreading out payments in a way that aligns with your cash flow. The key difference? You're using BNPL as a payment method, not as a way to afford something beyond your means. The second rule might surprise you. Stick to just one BNPL provider. This is crucial advice that financial experts consistently emphasize. When you juggle multiple providers, you lose visibility into your total obligations. It's like trying to diet while having secret snack stashes in different rooms. You're setting yourself up for failure by making it harder to track your consumption. By limiting yourself to one provider, you're creating a centralized view of your commitments. This simplifies tracking and reduces the risk of payment overwhelm. Think of it as choosing one credit card instead of carrying 5. It's about maintaining control through simplicity. Rule number 3 is absolutely essential. Set up automatic payments. Many BNPL users report difficulties managing their payment schedules, which is no surprise given the unusual bi-weekly timing that doesn't align with typical monthly bill cycles. Consumer Reports emphasizes this point specifically. Automatic payments are your best defense against late fees and missed payment penalties. This doesn't mean you can set it and forget it, though. You'll still need to ensure your account has sufficient funds on payment dates. But automatic payments eliminate the risk of simply forgetting a due date, which is one of the most common ways people fall into BNPL trouble. Even with automatic payments set up, you need a backup system. That brings us to Rule 4. Keep a separate tracking system for all your BNPL commitments and due dates. This might seem redundant when you've already set up automatic payments, but it serves a different purpose. Your tracking system isn't just about remembering when payments are due. It's about maintaining awareness of your total financial picture. This could be as simple as a spreadsheet showing each BNPL loan, the payment amounts, dates, and remaining balance. Some people prefer dedicated budgeting apps, while others use calendar reminders or notes in their phone. The specific method doesn't matter as much as having a system that works for you. This visibility helps you make better decisions about future purchases and prevents the dangerous out-of-sight, out-of-mind mentality that can lead to overextension. It's particularly important because BNPL providers don't communicate with each other, creating information gaps that only you can fill. Rule number 5 ties everything together. Never stack multiple BNPL loans. The Consumer Financial Protection Bureau has noted that consumers who juggle multiple BNPL loans are at a significantly higher risk of missing payments. This makes perfect sense. Each new loan adds complexity to your financial picture and increases the risk of overextension. The safe approach is to completely pay off one BNPL loan before taking on another. This creates a natural circuit breaker in your spending patterns and prevents the accumulation of overlapping payment obligations. Think of it like finishing one book before starting another. It helps you stay focused and complete what you've started. These 5 rules form a comprehensive framework for responsible BNPL usage, but they require discipline and commitment. Ask yourself honestly, are you willing to follow these strict guidelines every single time you're tempted by that BNPL button? For many of us, the answer might be no, and that's perfectly fine. Traditional payment methods might be a better fit for your financial style. But if you're committed to using BNPL responsibly, there are a few additional practices that can further protect you. Consider setting a personal rule about the types of purchases you'll use BNPL for. Maybe you'll only use it for items over a certain dollar amount, or only for specific categories like electronics or appliances, not clothing or everyday items where impulse purchases are more common. You might also benefit from implementing a waiting period before any BNPL purchase. When you feel the urge to click that BNPL button, give yourself 24 hours to think it over. This cooling off period can help you distinguish between genuine needs and momentary wants. The truth is that BNPL can be a useful tool in very specific situations. For example, if you've had an unexpected necessary expense like replacing a broken refrigerator, and you've carefully evaluated your budget to confirm you can make the payments, BNPL might help you manage your cash flow while avoiding credit card interest. Remember that the goal isn't to use BNPL to stretch your budget beyond what's reasonable. Instead, think of it as a structured payment plan for purchases you would make anyway. This mindset shift is critical. You're not using BNPL to afford more. You're using it to manage the timing of payments for what you can already afford. The statistics tell an interesting story. While 41% of BNPL users report problems with their loans, the flip side is that many users do manage these services successfully. The difference often comes down to financial discipline and conscious decision-making rather than reactive spending. So can BNPL be used responsibly? Yes, but only with clear boundaries and consistent habits. By treating BNPL as a payment method rather than a way to afford things beyond your budget, and by maintaining strict control over your total obligations, you can potentially navigate these services without falling into their traps. So we've reached the end of our BNPL journey, and while this industry continues to grow, projected to drive a massive $84 billion in consumer spending in 2024 alone, you're now equipped with the knowledge to make smarter choices. The BNPL checkout button isn't going anywhere, but you don't have to be caught in its web. Remember that splitting payments doesn't magically make something more affordable. It just spreads out the financial commitment while potentially exposing you to hidden fees and penalties that financial advisors consistently warn about. When you're tempted by that next online purchase, ask yourself, would I buy this today if I had to pay the full amount? Your long-term financial health deserves more consideration than the fleeting dopamine hit from clicking buy now. Your future self will thank